Assalamualaikum warahmatullahi wabarakatuh. Hi everyone, thank you for watching this video. My name is Mohammad Adhiya Riswandha. You may call me Adhiya. And today, I'd like to present to you my thesis with the title, Can Investors Profit by Following Analyst Recommendations? Evidence from Indonesian Stock Market. Without further ado, let's get started. I'd like to start my presentation by explaining about the background of the study. Why conducting the study is very important in current situation. For many decades, there have been myriad debates among scholars with regard to the relevance of efficient market as one of the foundation in finance literature. Based on the theory of efficient market, developed by UGM the novelist, in 1970, security prices fully reflect all available information in the market. In other words, under this paradigm, there is no scope for investors, traders, analysts, or just for everyone to earn abnormal returns after they adjust for risk. At its simplest, there is just no free lunch in the stock market. Nevertheless, it is very common to see a phenomenon where brokerage houses, analysts, spending a huge amount of money to conduct a research on security. They gather array of economic data, companies' information to predict the movement of the stock price. Here, we see a contradiction between what the theory says and what the reality looks like. Interestingly, many researchers found an empirical evidence that market is not always efficient and investors could earn abnormal returns. Particularly in this topic, Stickle and Womack in 1995 and 1996 were the first who document that when investors follow buy recommendations from analysts, they would yield positive abnormal returns. Then it becomes a very interesting story. This research has brought considerable attention among scholars. However, the presence of this phenomenon was majorly tested and found in developed markets, such as in the United States, United Kingdom, and most of European countries. As far as I'm aware, there are only few research that examine this particular topic in emerging market, especially in the context of Indonesia. It is important to note that many researchers have confirmed a very different characteristic between developed market and emerging market. So, just because you could follow analyst recommendation in the United States, it doesn't necessarily mean that you could do the same in the case of Indonesia. Not to mention, in Indonesia particularly, short selling is not allowed. Thus, sell recommendation might not be relevant in this case. Based on this story, a further task to examine the effectiveness of analyst recommendations to help investors to generate abnormal return is indispensable to be conducted. And based on this background, the research question of this study would be, can investors profit by following analyst recommendations? Now, let's proceed to chapter 2, literature reviews. In this part, I'm not gonna talk everything in deep. You could read my research paper if you're interested. But in general, there are three main topics that I covered. First, I talk about efficient market hypothesis and its implication to price formation. I talk about the logic behind this concept and several forms of efficient market. Second, I talk about behavioral finance and anomaly in the stock market. I talk about why behavioral finance has become a very important field in finance and economics. And I also provide several examples of anomaly in the stock market. Last but not least, I review several prior studies that have the topic of analyst recommendation. And based on these prior studies, we develop a hypothesis. A hypothesis of this study would be buy recommendations do help investors to generate significant abnormal returns. Now, let's talk about how we're going to conduct this study. First, let's talk about population and sample. The population of this study is analyst recommendations for all go public companies listed in Compass 100. And the period of observation is from 2018 to 2020. We use non-probability sampling techniques with the criteria as you can see in the slides. First, the firm stocks must be regularly traded in the market. Second, there should be at least one analyst that give a recommendation during the period of observation. Last, they must have a complete and accessible data. And the data that we are gathering in this study, there are mainly 5. Analyst recommendations, stock price, Jakarta Composite Index, market capitalization, and government bonds. Now, let's talk about how we're going to test the hypothesis. First thing that we're going to do is we're going to construct a portfolio based on analyst recommendation. It is important to note that instead of examining analyst recommendation as an individual recommendation, we're rather interested to examine analyst recommendation as in consensus recommendation. Thus, the first thing that we do is we're going to categorize the recommendation into 1, 2, and 3 rating, represent for buy, hold, and sell respectively. After that, the average analyst rating is calculated. As you can see in the formula, it is the sum of all individual ratings on that day when analysts publish the recommendation divided by the total number of analysts on that day. And those that are ranged between 1 and 1.5 are going to be included as a portfolio that we're going to test it at the end of the day. After determining the composition of the portfolio, the next step is calculating daily return portfolio. In this case, on the right hand side, you might see we are using value-weighted return formula. We are weighting the stock based on their market capitalization. Because according to Barber, the use of value-weighted return is more representing the real return of the portfolio compared to equally weighted return. To evaluate the performance of the portfolio and to examine whether or not by consensus recommendation do help investors to generate significant abnormal returns, we use 2 models. First, we are using mean market adjusted return, which is the difference between return market and return portfolio. And second, we are using intercept test using the framework of CAPM. And for mean market adjusted return, we're going to use one sample t-test, and for CAPM, we are using OLS regression. Now, let's proceed to Chapter 4, Data Analysis and Discussion. But before we go further to talk about the finding of the study, I'll talk briefly about the description of the data. Using sample criteria stated in Chapter 3, of 100 stocks in Compass 100, we exclude 19 stocks due to the absence of recommendation. Thus, the final sample used in the study are 81 firms in total. Next, let's discuss about descriptive statistics. There are several points that I'd like to point out from this slide. First, if you may see column 4 and column 5, it shows that although the covered firms only constitute about 10 or 11% of the total firms in the market, they already have covered more than 65% of market capitalization from all firms listed in the market. This justified the use of Compass 100 as sample of this study, because we are interested to see sample firms that have high market capitalization. Why? Because according to previous studies, they have confirmed that analysts tend to give more recommendation to firms that have high market capitalizations. Second point that I'd like to point out from this slide is the last column, average rating. This result shows that there is a consistent average rating of about 1.3 or 1.4. This indicates that analysts tend to give more favorable recommendation or more buy recommendation compared to other recommendation. And this result is consistent with previous studies where they argued that analysts tend to give more recommendations and are reluctant to publish sell recommendations. Now, let's see the finding of the study. Based on this histogram, you can see clearly that buying shares that consist of buy consensus recommendations earn negative mean returns of minus 0.0124%. And statistically speaking, based on the result of one sample t-test, it shows that there is a significant different average return from zero, which is about minus 0.024%. And this result is statistically significant at p-value less than 1%. In other words, the mean returns of constructed portfolio is significantly lower than that of market return, according to one sample t-test result. What about CAPM? Based on the output of the OLS regression, it is found that the intercept or Jensen's alpha is minus 0.025%, and it is significantly different from zero with corresponding p-value less than 1%. Assuming that the CAPM holds, the negative alpha here means that buy portfolio lies below the security market line for this period of observation. In other words, this result reveals that the portfolio consists of buy recommendations are found to be underperformed relative to the market return as the benchmark. Now, let's discuss the result of the study. Although this study is contrary to the findings of Barber et al. In 2001, this study supports the study by Jagadish et al. In 2004, where they also found that higher consensus recommendations are associated with negative returns. In addition, this study is also in line with the study of Su et al. In 2019 in the case of United Kingdom, where upgrade to buy portfolio provide investors with negative abnormal returns, and this result is significant at 5% level. To be specific, in the case of United Kingdom, when investor buys stocks that analysts just upgraded to buy, it will generate abnormal return ranging from minus 4.55 basis points to minus 6.02 basis points. We come to an end of this presentation. In conclusion, regardless of the model used in the study, they gave you similar results, where constructing portfolio that consists of most favorable stock based on analyst consensus fails to help investors to generate significant positive abnormal returns. On the contrary, this portfolio underperforms the market, where they generate significant negative abnormal returns. With regard to the limitation of this study, there are two limitations that I'd like to point out. First, I only able to cover analyst recommendation released by the brokerage houses, not specific to the analysts who might have a particular reputation in giving recommendation. This is due to the inaccessibility of the data. And second limitation is I do not include firms that are not covered by analysts. Thus, comparing between firm shares that are covered and firm shares that are not covered are not possible in this case. Lastly, I'd like to give several recommendations. First, for investors. It is better for investors not to easily trust and rely solely on analyst recommendations when constructing their investment portfolio. Consider other factors. Second, for future researcher, it might be better for you to extend the period of observation to see whether or not the result of the study is consistent among different periods of observation. And for future researcher too, it might be better for you to add some models such as Fama French factor or K-Hart factor model to make this study more robust. Lastly, for a future researcher, it might be better for you to examine other factors such as the effect of global financial recession, the speed of analyst revision, and analyst objectivity to examine whether or not analyst recommendation do add values for investors. That's all for my presentation today. Thank you for watching this video again. Assalamualaikum warahmatullahi wabarakatuh.